that just about wraps it up for summer, and as the evenings start to draw in, investors will be looking to both macroeconomic data and the latest company reports to shed some light on what's going on in markets. Two sets of numbers will dominate. In the UK, we can look forward to the latest Purchasing Manager Indices, or PMIs, from the manufacturing, construction and services industries on Monday the 3rd, Tuesday the 4th and Wednesday the 5th respectively. Remember that a reading above 50 is generally indicative of growth, where one below 50 shows a possible slowdown or even a recession. The last readings, as we can see here, were all solid enough to suggest that the UK economy is chugging along, but doing no more than that. The scores on the doors were 54 for manufacturing sector, 55.8 for construction, which was the best figure since May 2017, and 53.5 for the services sector. The other big piece of macro news due next week is the latest non-farm payrolls, unemployment and wage growth numbers coming out of the US. They're going to be released on Friday the 7th of September. And just to remind you, America added a slightly disappointing 157,000 jobs in July, which was below the 12-month average of 196,000, although some economists argue this could simply reflect how the US is running out of suitably skilled workers after a 10-year economic upturn. After all, the jobs gain was still enough to take unemployment down to 3.9%, but it failed to boost wage growth, which remains stuck at 2.7% year on year. If wage growth does accelerate, that could prompt the US Federal Reserve to raise interest rates more quickly than expected. Currently, at the moment, the market's putting a 96% chance on a third rate hike this year when the US Central Bank meets in September, taking rates up to 2.25%, and a 61% chance of a fourth hike in December to 2.5%. This week, company-wise, 4 FTSE 100 firms will host their annual general meeting or release a trading update or results, along with a number of mid and small cap firms. On the list this week is packaging giant DS Smith, housebuilder Redrow and Midlands-based industrial property expert A&J Mucklow on Tuesday the 4th of September, housebuilder Barratt Developments on the 5th, another housebuilder Bovis, as well as retailers Dixon Carphones, Halfords and Carpetright on the 6th, and FTSE 100 hazard detection specialist and dividend growth legend Halma on Friday the 7th of September. But for me, the most likely source of fuss in the week ahead is the trading statement due from high-end housebuilder Berkeley on Wednesday the 5th of September. All of the talk may continue to centre on housing shortage, but Berkeley's shares have not done that well over the past 12 months. They're broadly flat, as we can see here, while the FTSE 100 is up by around 4% over the same period. Concerns over UK consumer confidence, Brexit and the broader economy may not be helping the shares, especially as Chairman Tony Pidgley issued a cautious outlook statement alongside the full year results in June. He forecast a third drop in pre-tax profit for the current financial year, down from what he termed a peak of 935 million in pre-tax profit. When the results are released, the first thing to check out is whether Mr. Pidgley has changed his outlook at all. After that, watch out for any comments on the land bank. To reflect its cautious outlook, the firm stopped adding to its land bank, even if it has given no indication that it's looking to sell either. And finally, watch out for any comments on the balance sheet. Berkeley ended its latest financial year in April with a 687 million net cash pile. That underpins the firm's plans to return some 700p per share in cash to shareholders via dividends and share buybacks by April 2021. That's a significant sum when compared to the share price of around £37 and adds to the 934p a share that's already been handed over. Berkeley's focus on high-end properties in the southeast means it's far from typical within its peer group. Just 4% of sales last year, or around 157 houses, were supported by the Help to Buy scheme, and its average selling price was £719,000. But any comments Mr. Pidgley and Chief Executive Rob Perrins make on the broader outlook are always useful, and you can check out those figures from Redrow, Barratt and Bovis too, to build up a bigger picture of UK house builders overall. Thank you for watching, and I look forward to seeing you next week.